Well, it's logical if you think about interest rates. You take away the interest rates, a whole different game. But the interest rates around the world are low, low, low. And the central banks keep saying we're going to keep doing this and we're going to print more money and we're going to create more reserves and we're the only game in town. And when you take interest rates so low, all asset prices rise. Real estate, we are getting a recovery, stocks, precious metals, art, you name it, if it has a price attached to it, it's got an upward bias, and that includes the stock market.
But are stocks overvalued? If you look at earnings, revenue growth.
I hear this all the time. Look at the PEs. With slow growth economy, where are the earnings going to come from? Valid questions. But when you ask them, do you ask them in the context of an interest rate that's zero? There's a thing we call the equity risk premium. It's a very conventional, acceptable way to value stocks. If the interest rate is zero, the equity risk premium is infinity. It means you could buy stocks forever. Now we know you can't do that. But that low interest rate distorts traditional valuations. The second piece is we're going to have it for a while longer. So fighting it doesn't work. Moving away from it down the road, years from now, when the time comes, is another matter. That's the time to get off the stock market, not today.
So what do you like in the stock market then?
Well, I'm an ETF manager. So we use separate accounts, and we use broad-based ETFs. We think the market has an upward bias, so we want to broaden it out. We don't want to narrow it in on the big caps only. For example, RSP, the symbol RSP, gets you an ETF of the S&P 500 index equal weighted. SPY gets it for you cap weighted. When the market's broadening and rising, you want the equal weighted version, not the cap weighted version.